In this video, we'll dig a little deeper into Buffett's investment style, provide some real-world examples of how he's implemented his investment philosophy. Here are some of the most important Buffett investing principles that you can incorporate into your own investing strategies. Buffett's investment philosophy places great importance on prioritizing a margin of safety. In simpler terms, a margin of safety refers to certain characteristics of an investment that provide protection against potential financial losses for investors. To illustrate, if a stock is trading at $10 per share, but the realistic value of the company's assets is $12 per share, then there exists a $2 margin of safety. This intrinsic value of the assets acts as a deterrent against significant declines in the company's stock price. Buffett's objective is always to acquire stocks at a price lower than their intrinsic value. Warren Buffett avoids investing in low-quality assets. It is uncommon for him to acquire struggling companies, even if they are available at a low cost. A valuable quote from Buffett that novice investors should take to heart is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Here is another crucial advice from Buffett that holds immense significance for novice investors. Avoid purchasing specific stocks solely based on popular opinion. Conversely, refrain from constantly adopting a contrarian approach and selling stocks that are popular among the masses. He says, "The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd." The primary objective of stock investing is to purchase stocks at a low price and sell them at a higher price. Warren Buffett, a renowned investor, appreciates when stock prices decrease as it presents him with opportunities to purchase stocks at discounted prices. Buffett embraces these discounts on his preferred stocks and famously advises, "Opportunities arise infrequently. When they do, don't hesitate to seize them." Warren Buffett emphasizes the importance of long-term investing with his quote, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Buffett's investment decisions are not based on short-term price predictions. Instead, he purchases stocks with the intention of owning them for a substantial duration. While he does sell stocks frequently for various reasons, his general approach is to view investments as long-term holdings. Warren Buffett once provided valuable advice when asked about a loss-making investment. "The most important thing to do if you find yourself in a hole is to stop digging." Surprisingly, he acquired a significant stake in Freddie Mac, a mortgage agency, many years ago. However, prior to the 2007 to 2009 financial crisis, he observed that the company's leadership was engaging in unnecessary risk-taking, prompting him to sell his shares. When the crisis unfolded, Buffett's decision proved to be astute. Warren Buffett serves as a prime example of the immense impact of long-term compounding. Buffett effectively leverages compound interest, dividend reinvestment, and the continuous reinvestment of cash flow generated by Berkshire's businesses to his advantage. The results of this approach are truly remarkable. Since Buffett assumed control in 1964, Berkshire has achieved an impressive average annual return of 20.1%, surpassing the S&P 500's average of 10.5%. Buffett frequently dedicates extended hours at his office in Omaha, Nebraska. It often surprises investors to learn that he spends the majority of his time just sitting alone and reading or not doing anything at all. He's been quoted as saying, "I insist on a lot of time being spent, almost every day, to just sit and think." Buffett perceives knowledge as a resource that grows exponentially over time, and he attributes a significant portion of his accomplishments to amassing extensive investment knowledge.